welcome back. Let's get right into it. So what you're looking at is my Robinhood app. I use the Robinhood trading app. So this is one Friday. So Friday I did pretty good, got like 0.5% back. But for the week I'm down $6. For the month I'm down $75. So this is a tough month. And overall it's $86. And I attribute some of that to the fact that I am the master of timing. I entered the market at the highest it's ever been in history. And we haven't hit that top again. So it was probably the very worst time to get started in investing, but I'm not worried about it. And I know that in a long-term investment strategy, I'm going to get that back. So what I want to do now is, seeing it's the end of the month, is go back and look at the other videos that I did, specifically the companies that I mentioned, and see how they're doing. AIEQ, I mentioned that in a previous video. That's the artificial intelligence ETF, an ETF that's controlled by DeepMind, I think from IBM. I'm up $1.38 on that, so that one stays pretty steady. There's not a lot of fluctuation in that, but it's interesting to watch. And if you go to the AIEQ website, you can actually see what companies the AI is choosing to buy and which ones it's choosing to sell. It's neat to watch, and I think that the way AI works with like deep learning, I think it will exponentially increase in its ability to trade profitably. Next up is OHI. That was another one I covered, and OHI is one of my profitable investments at 83 cents. So not a super gain, but it's not a loss. XOM, I'm gonna talk about XOM today and why I think it's gonna be a good buy. Then we have MPW, that's only down $1.08, and then EQM is up 92 cents. So those were all the ones I've spoken about previously. All right, so one thing I wanted to mention was I've kind of noticed a trend, and if you've been watching my videos, you know that I'm kind of getting bearish on the market. But one thing I notice on my Twitter feed, and I'll see if you can notice the same thing. I'll just read a couple of these here, see if you notice a trend. All right, so Natty Light is giving away $1 million to help grads pay off student loans. So companies just dishing out some money. United Airlines is replacing small employee bonuses with a chance to win a car or $100,000. Bloomberg, have $10,000 to invest right now. Here's what the experts say to do with it. The inventor of the iPod is explaining this year's coolest new watch. So we've got expensive devices. Netflix is now worth more than CBS and Viacom combined. And was this $1,600 Uber ride the most expensive ever? So if you scroll through your social media, and this was just a few that I pulled out, there's dozens and dozens and dozens of examples of where it seems like there's just a huge influx of cash. I mean, companies are just dumping money onto their employees. They're just handing it out to customers. It just seems like there's so much cash just floating around the system. And if people are saying, well, where's the inflation that everyone's warning about? I think that's where it is. I think it's in the market. I think that's why, as a value investor, I'm having a lot of trouble finding a good value company that's not overpriced, because everything is overpriced, because I think the inflation is in the market right now. I think companies just have way more money due to inflation. And I think that's going to be a big problem real soon. So my strategy going forward, I'm going to start backing away from investing in companies, and I'm going to focus more on commodities. So I'm going to start getting into gold and silver. It might be gold and silver ETFs. I might spread it around. Also physical. I'm going to go back to investing in physical gold and silver. Grain. So I think grain, like feed, like corn, wheat, I think all that will go up. And right now it's really low. Like the grain prices are pretty low right now. And oil. So that brings me to Exxon Mobil, and why I think that's going to be a good buy. All right, so the ticker is XOM. So the price to book value. So this is book value per share. So if you take the entire company and you take its worth and you divide it up by each share that it has, That's its book value per share. So the price to book value is it takes the price of that share, divided it by the book value per share. So if you had a company that's worth $100 and there's 100 shares, the book value per share would be $1. If it cost you $2 to buy that share, the price to book value would be 2. So the price to book value for Exxon is 1.76, which isn't bad. Next we have the PE ratio. And what the PE ratio is the price of the share divided by the earnings per share, which is also, you'll hear, that's usually called EPS. So EPS is earnings per share. So how much did the company earn divided by how many shares are there? So the PE ratio is the price, which you want to be small, over the earnings, which you want to be large. So when you have a small number on top of a large number, you want basically you want that to be small. So the lower the PE, the better. And generally you want to stay below 15, but below 20 is not bad. So Exxon Mobil has a PE ratio of 16.11. It's not that bad. All right, so next is the dividend yield. And again, so far this YouTube series has been focused on sifting through dividend stocks, and this might be my last one. So the dividend yield is 4.08%, which means if the dividend didn't change and the price of the stock didn't change, and you bought $100 worth of shares, at the end of the year, you'd get $4.08 back. And as long as the dividend yield doesn't change, the percent doesn't change, then you'll keep getting that dividend. 4.08 is not bad. Next is why I really like this company. So this is the debt to equity ratio, and you want that to be small as well. And what the debt to equity ratio is the amount of total debt divided by the amount of total equity. So you want a really small debt on the top, really large equity on the bottom. So you want that number to be very small. And Exxon Mobil has a 0.13 debt to equity ratio. So that goes back to one of the two main reasons I'm going with Exxon Mobil is, one, I think interest rates are going to keep rising, and if that happens, any company that's over leveraged is gonna get crushed. So the fact that they don't have a lot of debt is good. And two, with inflation rearing its ugly head, if inflation increases at the rate that it's being predicted to, then commodity prices are going to go up. Oil is a commodity, so Exxon Mobil will be directly tied to that increase in the commodity price. So I think that the actual share price will go up for Exxon, as well as their earnings. So the last thing is the current ratio, and that sort of flip-flops the ratio from the debt to equity. And the current ratio is the amount of current assets over current liabilities. So if the company had to close today and liquidate, that's pretty much how well they would do. And the current ratio is a little low. So you want the current ratio to be high because you want to have a lot of assets on top and a little bit of debt on the bottom, current liabilities rather. Current ratio is not great. You want, according to the Investors Podcast, you really want that to be above a 1.5, and it's a 0.82. So that's kind of the only thing I'd worry about with ExxonMobil. But what's the likelihood that one of the largest oil companies on the planet is going to have to liquidate tomorrow? Probably not going to happen. So I'm not worried about that scenario. I think this would be a good recession-proof play. Overall, I like the PE ratio. I like the price to book value. I like the yield. I like the debt to equity, and I'm not too concerned about the current ratio. So I think ExxonMobil will be. I'm going to start dollar cost averaging into ExxonMobil and just buy a little bit each week. Put the same number of dollars towards it. If I don't have enough for a share, I'll just roll it into the next week until I get enough, and I'll buy it. Yeah, so that's ExxonMobil. So next we can get right into my goals, and they weren't that great this week. Let me get that. Sobriety. Yes, I stayed sober again. I don't have a strategy to share today, but I will just say that as time goes on, it gets easier. You think about it less. Like for the first couple of weeks, it's the only thing that was on my mind. Like every night when I was coming home, I just wanted to grab some beer. The other day I was just coming home and I was listening to Stitcher, which is just podcasts, Didn't even think about it. Just drove home. I also had a really stressful day at work this past week. And typically that would mean that I would go and get a 12-pack and just, erase my brain. But I didn't have to. So I will say that if you can get some time underneath you, it gets easier. So it's just getting easier and easier. Did I lose 0.6 pounds? No. This is the first week I didn't lose weight. All right, so I'm still on target. So my target weight was 231.2 for fiscal week 8. I'm at 222.8. So I'm on target, but I actually gained 0.2 pounds. And this is the first week that I didn't lose weight. So I'm thinking maybe I plateaued. Like maybe this is where doing nothing is going to get me, because it's pretty much what I've done so far, other than like cutting out beer, junk food, and swimming on Sundays. I also didn't go swimming last Sunday. My wife and I decided not to go. So I'm wondering if that's, I don't know if that could affect it. I don't know if that could affect it. I don't really. So what is my plan going forward? Well, I got to get that 0.2 back, and I got to go another 0.6. So I've got to get like 0.8 by next week. So I'll probably have to exercise, which I definitely don't want to do. But I got no choice. First week going up, it didn't feel good when I took that picture of the scale. I was like, come on, 0.2. But yeah, I'll probably implement something. I know I kind of tapered off on my push-ups and my sit-ups, so maybe I'll have to put them back on. I'll just have to up my game. I'll have to go from doing almost nothing to doing maybe a little bit of something. But yeah, I was disappointed in that. I thought I was doing so good. At one point in the week, I had weighed myself, and I was at 220.4. And I was like, wow, I'm almost in the teens, which I don't think I've been that low since high school maybe, but then somehow I popped back up to 222.8. Not a big deal. And then plus 20 subscribers. No, and I'm still at 5, so I didn't really pick up any new subscribers. I have been upping my Twitter game. I've been networking with the Investors Podcast with Preston Pish, and I'll just keep reaching out. I think this might just come with time. I'm just gonna stick with it. It's healthy for me to have this video because it holds me accountable to the goals that I'm trying to achieve. So if I quit doing YouTube videos solely based on the number of subscribers that I have, then I feel like I might also lose sight of the other goals in my life, most importantly, sobriety. So I think this is sort of an accountability measure, and I'm going to stick with it. And if I don't ever get more than 20 subscribers, at least I will be able to achieve my goals and create a record where I can actually go back in time. Oh, sorry if I hit the mic. I can actually go back in time and look, where I made mistakes, where I could have improved, and basically just create like a log. It's the easiest way to create like a nice snapshot of each week in my progress towards investing. So I'm not going to beat myself up over the subscriber count. It'd be nice if I had more, but it is what it is, and I definitely like making these videos because, like I said, it keeps me accountable. All right, so that's that. I'm definitely going to try harder on weight loss. If you guys have any tips for me on weight loss, feel free to leave a comment. And to the 5 subscribers that I do have, thank you very much for subscribing, and please share this video if you get anything out of it at all. Thank you very much, and stay profitable and stay sober. See you next week.